Hi there, everybody. Thank you for joining us for this post-reporting season review. We're here to talk about the small and mid-cap funds and how they performed across the reporting season, and of course talk about the results more generally. I think fair to say, Lucas, quite an interesting, intriguing reporting season.
No, they always are.
That's right. Lots of winners, lots of losers, as they say. But I think generally speaking, a reporting season that was better than expected.
Yeah, I think that's a fair comment, Mark. But certainly with top lines, I mean, what we're seeing across most of the economy and the market is the top lines are reasonably anemic overall, but maybe better than feared.
That's right. I think consumers still in a generally a better place than expected. Whether that lasts is a different question, but certainly for what we saw in February, the consumer holding up pretty well, and retailers and discretionary and cyclical companies did tend to.
Yeah, I think that's right, Mark. But I guess I'd add to that comment with, particularly with discretionary retail. Yes, top lines were a bit better than fear, but what we also saw was a big focus on costs. You saw companies that had strong control over their costs rewarded, and retail is a sector that has benefited from lower freight costs, from maybe product deflation out of China, versus other companies and sectors that maybe have struggled to grapple with their costs. We saw some of the healthcare companies really having issues with labour.
That's right. So that was an interesting contrast. Also, so the discretionary retailers tended to outperform. Cost of goods sold benefits from lower costs, and they surprised on the upside. Healthcare companies, Australian Clinical Labs, which is one of the stocks we own in our portfolios, disappointing because those labour costs or increase in labour costs have been higher than expected and harder to get under control.
Yeah, I think that's absolutely right. And, a couple other large holdings of ours that we still really like, Kelsian, for example, very strong top line. Actually, their operating result was pretty good, but some higher costs below the line, depreciation and interest really hurt them. And TPG also, again, strong top line in mobile, but a lot of OPEX going into the business really disappointed the market and saw the shares underperform during the month.
On a brighter note, we had quite a few strong performers across the month, which was good to see. What were the highlights for you from that point of view?
Yeah, well, I think as I mentioned, Mark, that whilst top lines might have been better than feared across the market, still pretty anemic overall. And what we're also seeing really rewarded are companies that can offer strong growth in such a tough macroeconomic environment. Index is one that I'd highlight, had really underperformed based on what really looked like to us unfounded concerns that these issues with lithium and nickel were going to weigh on the exploration outlook. I mean, Index is a great company, world-class technology, a true industry leader. And what we've actually seen is that they're able to grow quite strongly, made a really good acquisition last year. HMC Capital is another we've seen really strong ability to attract funds under management. You're really seeing that operating leverage come through. The market was quite excited by that. And Hipays is another one that we've owned for a while. They have actually had the good top-line growth for a while, but we've seen that commitment to cash flow break-even this year. And again, really rewarded. Stock was up around 40% for the month. It was great to see. I know you've got a few stocks that you wanted to highlight as well, Mark.
Any stock up 40% is great to see, by the way, Lucas. But two strong performances, certainly from my point of view. One was Bega Cheese, up close to about 12 to 13% for the month. A long-term holding in the portfolios, and one we've really liked for a long period of time. Two parts of that business, the branded business. So we're familiar with the likes of Vegemite, Dairy Farmers, and Dare Ice Coffee and associated brands.
Don't forget Farmers Union, Mark.
Farmers Union, of course, being a good Adelaide boy, you know all about that, Lucas. But certainly that part of the business performing well and performed as expected. So that was good to see because they have had to cycle a lot of cost increase. They've been able to get those price increases through. The consumers held up pretty well, as we said at the opening of this segment, and so the trade down to their brands was evident in some way, but they've still been able to maintain those strong sales lines in their key brands, which is good. And then on their bulk commodity side, where the market's been really concerned about global commodity prices, and on the dairy side and where those prices have gone and what that means for the profitability of that part of the business. But you're still losing money in that business for this particular financial year, but they won't lose as much money as people thought, and that was a nice reason for the share price to perform quite strongly for the month. Another one that I liked in the reporting season was SG Fleet. Again, This is a stock we've owned for a long period of time. We've talked about it ad infinitum to many people over a long period of time. Market leader in the fleet leasing and fleet management sector of the market. A great result. Top line moving really well. And what I liked about the result was the quality was really good because people have been concerned that they've been benefiting from these second-hand disposal values of second-hand cars as fleet cars have rolled off their lease and they've been resold. Those prices have been elevated partly because of a COVID hangover. That part of the revenue line has actually been shrinking, which is good to see because the reduced revenues have been more than offset by new business wins and new
Yeah,
sales.
right. So one-off revenue lower, recurring revenue higher.
Yeah, so the quality of that result is actually quite pleasing to see, and the shares were strongly up for the month, up around 17 to 18%, and well justified, and still very cheap. So a lot of what we like in the reporting season, the likes of Ampol trading at all-time highs.
Yeah, deservedly so, I might add.
That's right. The likes of Horizon and so forth. These are long-term core holdings in the portfolios, all delivered well in terms of revenue growth, the ability to maintain margins, generating good cash, and paying us very good dividend yields at the same time. So that's what we're really focused on in the portfolio.
Yeah, I think that's a key point moving forward, isn't it, Mark? That it's great to see management get costs under control across large parts of the market, but you can't cut your way to growth. And longer term, we remain really attracted to these companies that have these sustainable recurring revenue, competitive advantages. And we still see a lot of M&A in the market as well. I mean, we don't own Altium. And I would point out that result was actually pretty terrible, but did get a takeover offer. But we did benefit in the portfolio from further M&A during the month.
We did. So QIP, or Quantum Intellectual Property Partners, has received a very early stage sort of tentative bid, and I guess you would say, but certainly one which is enough to give that share price a nice kick, something like 18% for the month, but also on the back of what was a very good result too. Costs out, but revenues also looking quite reasonable.
There's that theme again, Mark.
That's right. So in terms of outlook, Lucas, we're obviously heading into March and April, and we'll get more updates on companies as the year progresses, but hard to see revenue lines outperforming again. I mean, the consumer has outperformed today, but moving to a softer space, I think that's fair to say.
Yeah, I mean,
as you say, margins will be under pressure if you can't hold revenues, and costs are still going. So, what sorts of companies are we focusing on?
Look, I think the same as ever, Mark. We're just looking for high quality businesses that are trading at discounts to our intrinsic valuation, and we are seeing lots of opportunities for pockets of dislocation in the market and areas that we feel really good that we can make money for our unit holders. But clearly, the macro environment, it's not terrible. It's definitely better than feared, but it's not amazing. It does worry us maybe about some of these retailers that are trading at such stretchy valuations, despite what's still a pretty soft top line outlook. But we remain pretty optimistic for the outlook for the Australian economy, and certainly for the outlook for the companies within our portfolio.